Have you ever wondered how Japan's monetary policy has evolved over the years and what it means for the global economy? Picture this, a nation that has been a global economic powerhouse for decades, yet its monetary policy is shrouded in a veil of mystery and intrigue. Japan's monetary policy has been a subject of great interest for economists and financial analysts worldwide. This interest isn't just academic, it carries real-world implications. The strategies employed by the Bank of Japan have not only shaped the country's financial landscape, but have also influenced the global economy in significant ways. They've navigated through periods of rapid growth, stagnation, and everything in between, making their journey a fascinating study. So, what is it about Japan's monetary policy that keeps us on our toes? So, how did Japan's monetary policy evolve, and what led to its end? Let's delve into the history. The roots of Japan's monetary policy can be traced back to the post-war period. In the aftermath of World War II, the country was in ruins, and there was a pressing need for a stable monetary system to rebuild the economy. Thus, the yen was introduced as the national currency, replacing the old system of sen and rin. It was a bold move, signifying a fresh start for the nation. The establishment of the Bank of Japan, often referred to as the BOJ, marked a significant milestone in this process. The BOJ played a pivotal role in steering the country's economy out of the ashes of war and towards a path of growth and prosperity. It did so by controlling the money supply, setting interest rates, and ensuring the smooth functioning of financial markets. During this period, the BOJ pursued a policy of low interest rates to stimulate economic activity. This monetary policy, combined with government spending on infrastructure and industry, led to rapid economic recovery. The country's GDP grew at an unprecedented rate, and by the early 60s, Japan had risen from the ruins of war to become the world's second largest economy. But the BOJ's role was not limited to managing the money supply and interest rates. It was also instrumental in implementing financial reforms and introducing new financial instruments that modernized the Japanese economy. These reforms helped to create a more efficient and robust financial system that was capable of supporting the country's growing economy. Yet, as we shall see, this period of rapid growth and prosperity was not without its challenges. The BOJ had to navigate a series of economic shocks, including oil crises, asset bubbles, and periods of inflation and deflation. These challenges tested the resilience of Japan's monetary policy and led to the adoption of unconventional policy measures. From these early years, Japan's monetary policy took a unique path, leading to one of the world's greatest monetary policy experiments. From the ashes of war to economic powerhouse, the journey of Japan's monetary policy is a fascinating tale of resilience, innovation, and adaptability. As Japan's economy faced new challenges, the Bank of Japan embarked on a path of unconventional monetary policies. These weren't your everyday fiscal strategies. They were bold, audacious, and at times controversial. The Bank of Japan's playbook started to look very different indeed. In a bid to stimulate economic growth and combat deflation, the Bank of Japan introduced quantitative easing. This was a policy where the bank would buy large quantities of government bonds and other financial assets. The idea was to inject money into the economy, encouraging lending and investment. It was a gamble, but one the bank felt was necessary. And then came another unprecedented move: negative interest rates. The concept here was almost counterintuitive. Banks were effectively charged for keeping their money with the central bank, the aim being to encourage them to lend more to businesses and consumers. It was a bold strategy, and one that was met with mixed reactions both at home and abroad. But these policies weren't just about Japan. they had a profound impact on the global financial landscape. Countries around the world watched as Japan navigated these uncharted waters, with many taking notes for their own monetary strategies. Japan's unconventional policies sparked a global conversation about the future of monetary policy. Yet despite the boldness of these strategies, they were not without their challenges. Critics argued that these policies risked creating asset bubbles and financial instability. Others questioned whether they could achieve their intended effects in the long run. The Bank of Japan found itself walking a tightrope, trying to stimulate economic growth without causing new problems along the way. These unconventional policies marked a significant chapter in the evolution of Japan's monetary policy, but they were not without their challenges. Recently, Japan ended its experiment with unconventional monetary policies, marking a significant shift in its monetary policy. This move signals the end of an era, one that was characterized by negative interest rates. Governor Kazuo Ueda, at the helm of the Bank of Japan, led this transition, moving towards a range of 0 to 0.1% interest rates. The market response, surprisingly indifferent. The yen weakened, stocks rose, and the world watched as Japan dared to tread on uncharted territory. This change wasn't born out of a whim, but out of necessity, driven by market pressure and economic conditions. The Bank of Japan now faces the challenge of normalizing policies and unwinding massive holdings, a delicate balancing act that could cause financial instability if not handled with care. The end of Japan's monetary experiment marks a new chapter in its monetary policy, with implications that are yet to be fully understood. As we step into this new era, we watch with bated breath, wondering what the future holds for the world's third largest economy. Japan's monetary policy has been a journey of innovation, challenges, and change. Over the years, Japan has navigated a financial labyrinth, implementing unique strategies to stimulate its economy. From the outset, the Bank of Japan sought to combat stagnant growth and deflation, leading to the birth of unconventional policies. These policies, often seen as the world's greatest monetary experiment, included the implementation of negative interest rates. However, like all experiments, there comes a time when results must be evaluated and changes made. And so, Japan has recently ended this era of unconventional policies. Under the new stewardship of Governor Kazuo Ueda, the Bank of Japan has shifted to a range of 0 to 0.1%, ending its negative rate regime. Yet, the markets reacted indifferently, with the yen weakening and stocks rising. This move, while seen as a minimal effort to maintain credibility, signals a pivotal shift in Japan's monetary policy. As we continue to watch Japan's monetary policy unfold, it serves as a reminder of the dynamic nature of economics and the interconnectedness of the global financial system.